Hello again, everyone. I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today's date is Sunday, June 2nd, 2024. Today I'll be talking about what Asbury Research's latest data-driven market research and quantitative models are saying about the latest financial market conditions. That is, when to be on offense and looking for opportunities to buy, and when to be playing defense and protecting your capital. Asbury Research has been providing both investment research services and money management to individual and professional investors since 2005. For more information about us, visit asburyresearch.com, which is right here on our screen, and use the Contact tab, which is right here up at the upper right. Finally, if these YouTube videos are useful to you and you'd like to see more of them, please like and subscribe. Let's begin with just a couple of brief announcements. Our Memorial Day sale officially ended this past Friday, May 31st, which we were offering 10% discounts on both 3 and 12-month research subscriptions. But because the sale fell right in between our previous Following the Money podcast and this one, we are extending it for just another day through tomorrow, June 3rd. So if you're interested, all you have to do is visit asburyresearch.com. And again, go to the Contact tab and type Follow the Money Podcast 10% off right down here in the inquiry box. And we will get an email out to you that will allow you to sign up straight from that email. Finally, this upcoming Wednesday, about 10 days from now, on Wednesday, June the 12th, I'll be interviewed by Oliver Rennick of the Schwab Network at 9:15 in the morning, 10:15 Eastern. I hope you will join me there. Now let's follow the money by identifying the key areas of our focus over the next several weeks. Let's begin with a broad overview of current market themes. April PCE, which is a personal consumption expenditures. It's the Fed's favorite indication of inflation. On Friday, showed the smallest increase in core inflation this year. That triggered a huge reversal in the S&P 500 to very aggressively rebound from what we had identified as primary tactical support on Friday. We'll take a look at that chart a little bit later in the podcast. But Friday was kind of an inflection day, and then it came right down to the support level held, and we had a very strong Friday close, which are typically more important than just a close that's during the middle of the week. Another thing we're looking at, there's still a lot of jumpiness and indecision in the market this year, and you could see that in very erratic sector rotation. We look at that via our CEF model, which we're going to take a look at in a little bit more detail just a little bit later in the podcast. Another thing that we've noticed here that we think is important is non-U.S. equities and emerging markets have significantly weakened from about a month ago, where you saw EM outperforming, and there was 2/3 of the 25 foreign equity markets that we track in our U.S. versus the world model were all outperforming the S&P. That is no longer the case. And we see that as an indication of maybe a little bit more confidence coming back into the U.S. market as the S&P 500 and the NASDAQ have both set new all-time highs over the past week or so. Finally, metals are threatening a major bullish breakout. We think that is an area to watch. It could be a really good opportunity this summer. Especially with inflationary fears continuing to swirl around the markets. We will be looking at what we believe is an emerging opportunity in that space, again, just a little bit later in the podcast. Now let's move to Asbury Research's tactical models, which tell us where to enter and exit whatever the existing market trend happens to be. Today we'll be looking at the Asbury 6, which was created to provide a data-driven daily indication of the true internal health of the U.S. stock market. So we're going to go there now by clicking on the Research Center, subscribers only here, and going down to the Asbury 6, and we're showing it to you right there. The purpose of the Asbury 6 is to help prevent us as investors from making the same trading and investing mistakes that happen all the time due to all the confusing day-to-day volatility in the market right now, that at times has forced all of us, including me that have been doing this over 40 years, to make emotionally driven trading mistakes, forcing us out of the market and then having to buy fresh highs 3 days later. The A6 is meant to show us what the internals of the market are on a day-to-day basis rather than what I call chasing the tail of the S&P 500. So the Asbury 6 has been on a positive status since May the 3rd, while the S&P 500 has risen by as much as 4.2% since then. Four or more metrics in one direction, either positive, green, or negative, which should be red, indicate a tactical bias. So you can see right now, all six are green. So that means the internals of the market are strong. If you look at the dates here, you can see that the model actually last Wednesday was 3 and 3. It was 3 red and 3 green, which told us that it was in balance and we were coming into an inflection point in the stock market in terms of a tactical short term kind of a pivot for the market. But right now you can see as of May 30th and 31st, we got volatility, trading volume, and market breadth back on the green side, which is giving us a positive scenario heading into early next week. As long as the Asbury 6 remains on a positive status, it'll indicate to us that the U.S. broad market is healthy enough on the internals to keep the current October 2023 rally intact. If we do shift to four or more of these individual metrics, if four or more of them turn to red, that will indicate that the market has weakened internally, and it will be a good indication, especially if we break the support level that I'm about to show you here in a couple of minutes. That would indicate to us that the internal condition of the market has changed and we're beginning some kind of a corrective decline. According to our back testing, since Q4 of 2017, the Asbury 6, using it for 4 green, is in the market and 4 red is out of the market. It has made 13% on an annualized basis versus 11.6% for SPY. So a little bit better yearly annualized performance than SPY on the back test, with only a 13.6% maximum drawdown compared to a 33.9% drawdown for SPY. The downside on this is it's active. It's very sensitive to the market. It trades about 11 times a year, which means there's 11 round turns a year. So for those of you that don't like that much activity, this might be the model. This might not be the model for you, the correction protection model, which you can find a little more about by going to models and then scrolling down and finding that model. That may be a little bit more suitable for you. It's about 5 round turns a year. So this is very active, but it keeps you from taking drawdowns. And if you're willing to do the work, historically looking backwards, since we can't see the future, it has performed quite well. Next thing we want to talk about is our sector rotation. We're going to go ahead and have a look at our SEAF model here. Going back to the Research Center, SEAF stands for Sector ETF Asset Flows. And what SEAF does is tracks the movement of the assets rotating around the 11 sector spiders, which together are the S&P 500. There has been a lot of frenetic rotation going on in market sectors so far this year, but without a lot of relative outperformance by any particular sector. It's been kind of unusual in that way. So year to date, the S&P 500 has risen by 10.64%, but with only 4 relative outperformers, and 2 of them are really relative performers. Specifically, in utilities, utilities has outperformed by 4.2% so far this year versus SPY, versus the S&P 500. The SEAF model has been overweight utilities since early May. You could see it's our #1 ranked sector heading into next week. So we've been able to pick up some outperformance there. Communication services, the second decent outperformer. It's outperformed by 3.9% this year, again, versus SPY. We've been in and out of that sector for much of this year, and you can see right now it's the #2 ranked sector. The only 2 other sectors that have outperformed the S&P 500 this year have been energy and financials. Energy has outperformed the S&P by 0.54% year to date, and financials only by 0.17%. So effectively, we have two outperformers. We've been in and out of them for much of this year. Sector rotation investors need sustained and significant relative sector outperformance to succeed. And just thus far this year, we haven't seen that. However, that tends to be, that is not the norm. The norm is typically once or twice a year, anecdotally, a couple of times a year, you're going to get an outperformer that's going to last several months. And that's the basis of SEAF, is it's very good at detecting those moves early because it's following money. It isn't waiting until we can see the outperformance on the chart. It's actually following the flows around those 11 sectors. Let's take a look at that by going to a different view here. Let's make this a little bit bigger. This is our rainbow charts. Our rainbow charts are a part of the SEAF model, and all they do is they show the SEAF model ranking for the 11 sectors going back for 1 year. So this is 1 year of history going back here, showing the ranking. We have a favored ranking, a neutral ranking, and we have an avoid ranking, which are green, yellow, and red. As we look down the chart, you can see here the utility sector, according to the SEAF model, it moved to uh, favored status on April the 30th, right here. And really, this is the best that the utility sector has done, according to a SEAF ranking, looking back across the whole year. But you can see since April 30th, down here is the relative performance, the um, corresponding relative performance chart for XLU, the ETF that tracks the utility sector, versus SPY. And you can see ever since we went into a favored status here, utilities has outperformed by 4%. I think this is a good visual to help you to understand how the SEAF model works. The next thing we want to do is we're going to go back to the research center, and now let's look at three important charts from Friday's Keys to This Week report. Keys to This Week, as the name suggests, a weekly report that features a bullet-pointed list of 10 key market factors with the accompanying charts that we think are the most likely to influence market direction looking over the next 1 to several weeks. So let's go down and look at Friday's report right now. And here it is right at the top. And we're going to scroll down to three of those charts. Here's a summary up here. But the charts that I want to show you today that I think are especially important considering what we've talked about so far. This is a chart of the S&P 500 daily. It goes back to Q4 of last year. And what it's showing, this chart hasn't been updated in a couple of days. But what this was showing is at the time of this chart, which was 5:30, we were looking at support at 51.80 to 51.60. On Friday, we came all the way down to 51.80, held, and now we closed back up above 52.65. So a very strong day. It was an outside range day with a higher close. And the reason for that was the PCE number was very benign, which gave investors, traders confidence that the Fed is not going to be in any hurry to try to raise rates, to throw a wet blanket on any additional um, indications of inflation, and the market loved it. So again, the integration of knowing where the numbers are, knowing when the numbers are coming out, knowing what the expectations are, and transposing them onto your chart. So we had been talking about 51.80 to 51.60 as a key tactical support level. And again, the what's going on in the market, what's going on in the news, what's going on in terms of economic reports and the chart are just like this. And being able to integrate them is an important part of knowing where the opportunity is. The second thing I want to look at as we back out of here is we're going to take a look at one key tactical indicator that I think is going to be really important next week. This is the cumulative volume index for the NYSE down in the bottom and the S&P 500 up top with the 21-day moving average. Why the 21-day moving average? Because that's Asbury Research's tactical time period. We look at anything tactical that we view as a tactical metric in a 21-day lens. If we're looking at strategic, which is the trend we're trying to catch, we will use a 63-day lens, which is a business quarter. But for this particular example, we got a 21-day moving average. So from February 8th to April the 11th, the CVI was up above its 21-day moving average. Volume indicates urgency to buy. It's a great way to explain that. Day-to-day urgency to buy is what volume shows. So you can see volume is expanding on a 21-day monthly basis from Feb 8th to April 11th. That helped to fuel this nice rally that we had in the S&P 500. From April 12th to May 1st, dropped below the 21-day. There was they were losing urgency to buy. That particular index was indicating the urgency to buy was receding. That gave us this on the chart. Now from April 2nd, we're expanding again on the CVI. Look where we are heading into next week. We are sitting right on that 21-day moving average. So what does that mean? That means that that support level that I showed you in the S&P is very important next week, because the CVI is also telling you this is where the market needs to re-engage the uptrend if that uptrend is still good. If we see some sputtering going on Monday, Tuesday, maybe Wednesday of next week, I'm going to be looking here. I'm going to be looking at that support level. I'm going to be looking at the Asbury 6 to make sure that if this market starts losing its mojo, I want to be one of the first guys to know about it, so we can alert our subscribers, and we are aware of that for our managed accounts. The last one here on keys is a little bit longer term in nature, but I think it's pretty important as well, and that's investor sentiment. Here we've got the S&P 500 going all the way back to 2010, and with it, we've got the weekly investors intelligence data percentage of bears. Asbury Research is actually an input we're one of a number of research firms that are inputs into the investors intelligence data. And what this particular metric is showing is that since April the 12th, only 14 to 16% of firms like ours are bearish. Historically, that has been kind of a time bomb for what to look forward to in the future. You can see here March 2011, March 2015, January 2018, and so on. All of these times that we've gotten down into that least bearish mode, let's call it, it's been within a few weeks, sometimes a month or so, of an important top. We're there again. This is not a tactical signal. This is strategic for us. So that means even though the market is performing well right now, we're looking at it within the lens that the market has rallied by 30% since the end of October of last year. That's a big move. In the meantime, you're getting a lot of sector rotation. The market isn't sure what to do. Utilities is being favored right now in a bull market, and next week it might go back to communication services. Or actually, this is a perfect example. Our top two CEF sectors for this week are XLU and also services, communication services, and utilities on the opposite ends of the spectrum. One is very, very risk on, the other one is risk off. That's this churn that's happening up here as managers are not sure whether they should try to catch the next rally in the technology space, or if they should be hedging their bets by staying in the market but buying stuff like utilities. That's really where we are right now. The last thing I want to show you today is an upcoming idea that I think could bear some fruit here over the summer. And that is, this is Ring. Ring is the gold miners, the iShares Gold Miners ETF. Subscribers to our Follow the Money podcast, if you're a subscriber, you might remember that we had been bullish on the Silver Miners ETF, which is SLVP ticker, between March the 28th and April 16th. SLVP rose by 13% during that period while outperforming the S&P by 17%. It's a great trade, but we ran into some resistance and we decided to take a profit. We're seeing a similar setup here. It's an emerging opportunity, and we're seeing that opportunity in other places. We're seeing it in copper. We're seeing it more broadly in the metals and mining ETF. But what we have here is a very cautious breakout through a big resistance level in RING. That level's 2817. It represents the May peak of 2023, and also this big long trend line that originated back in August of 2020. If we can remain above the 2817 area, this could be a very good opportunity to get something that's outside of the equities realm. If you're nervous that equities are a little bit too high and sentiment might be a little bit too bullish, this could be an opportunity for us. The next formidable resistance level is way up here around $34. So we will be monitoring this very close for our subscribers. We actually already have a signal out there for subscribers, which includes stop loss and projected profit and so on. But for those of you that are subscribing to the Following the Money podcast, at least this is a little bit of a heads up for a potential non-equities related opportunity that we think could be a pretty good one this summer. So let's get back to where we were at asburyresearch.com. And that wraps up another Asbury Research Following the Money podcast for this week. Our next Following the Money is tentatively scheduled for Sunday, June 16th, 2 weeks from today. If you like our approach to investing, don't forget that we are extending that Memorial Day sale for 3 and 12-month individual investor subscribers only through tomorrow, June 3rd. If you're interested, make sure you contact us today by going to the contact tab and letting us know that you're interested so we can get you the correct email so you can sign up. Hope to see you here again soon. And please don't forget to like and subscribe. Have a great Sunday.